Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's been fascinating to watch the tech sector over the past year. Tech stocks were some of the best performing during the pandemic as our entire lives, from work to shopping, shifted online. And there were some standout performers. Afterpay had a remarkable year, so did Zipco. Afterpay's share price was $12.44 in March last year, and it got to almost $152 less than 12 months later. But it's come back a bit, along with much of the tech sector. Part of the shift from the pandemic-era stocks to cyclical stocks has been going on in recent months. I wanted today to take a look at the technology sector, where it's heading and where the opportunities might lie. Elise Kennedy is Vice President, Equity Research at Jarden. Elise, welcome to Fear and Greed.
Thanks for having me on the show, Sean.
Before we look at where we're now, what do you make of the Australian tech sector and how it handled the pandemic?
We actually think that this pandemic highlighted the value that you have in those tech stocks because you saw, as you mentioned, this flock to online platforms. So we think about these tech stocks along what we call an S adoption curve. So effectively, it's an area where you get these early innovators that start to try out the software. Then you start to get these early adopters. People are a little bit keen to try it, but they haven't really fully tested out, is this really mainstream? You really get that hockey stick, which is the S up in the curve, and where you kind of get the value when you get the late majority. And that's when you go, this product and this technology is reaching more of your mass audience. So with the pandemic, it helped bring forward that adoption curve because, as you pointed out, you've got all these online tech products that effectively you had to start thinking about. And online shopping's another example in that. You saw Zoom, again, that's another example. And even closer to home, Xero, that accounting software stock, that's had a run, again, because of this adoption of new technology that's online. And we also saw during that period the ability of some of these tech stocks that never make money. They showed that they actually can scale back their investment when they need to.
Okay, so what do you mean by that? Because one of the great dilemmas for people investing in tech stocks is that many of them don't make money.
Yes, that's exactly the challenge, is it's not your traditional price to earnings multiple metrics. So what I mean by that is, for example, we saw Xero. They've always been able to generate very good margins in Australia and New Zealand of 62%. And if you go and you looked at their international markets, they were loss-making. So you put those together and their margins weren't growing. But we saw last year, they weren't sure how businesses were going to end up through this economic cycle because they're an accounting software stock and they're levered mostly to SMEs. And you think those were some of the companies that were hardest hit. And so with that, effectively, they pulled back their sales and marketing, but those customers stayed. So you kind of thought, oh, actually, you're spending now to get the incremental customers, but the adoption curve's working for you, that in the long run, you should be able to make money, because that's the whole philosophy, is that effectively you're spending now, but when you finish your market growth, which is your revenue side, then eventually you should be able to get that profitability because those numbers start to drop out.
A couple of things there, an interesting example, because its share price did incredibly well during the pandemic. And I suppose a lot of us just thought because it was a tech stock and people were going online and cloud accounting software was a good way to go. But in a sense, there's a far bigger dimension to that. And it's actually management of the company. Management made sensible decisions in the moment, which helped the bottom line.
Yeah, that's exactly what happened. And we saw that again across a few other stocks. So management make a huge difference in their capability and knowing when to invest and when to pull back. So with the uncertainty in the market that we saw last year, the company made that decision, let's pull back our spend. Whereas now we're moving more into a recovery. We saw in the last half result that they said, hey, here's an option for us now to actually go and reinvest and to drive the uptake. So that's where we think that these tech stocks still have some room to continue to run, because now we're seeing the adoption curve and we're seeing the spend now that we're starting to move out of that pandemic.
Elise, stay with me. We'll be back in a minute. My guest this morning is Elise Kennedy, Vice President, Equity Research at Jarden. So many analysts will talk about the fact that the post-pandemic stocks are not tech stocks. They're what you would call value or cyclical stocks that tend to do better when the economy improves. But you do think there's still a way to run for some of these tech stocks.
Yeah, I think that's an interesting discussion because effectively a lot of those value stocks have had a run again because they're levered to rising yield rates. But you think about a lot of the stimulus that's in the environment, a lot of the debt that's in the economy, it's likely that you will see those rates lower for longer. That still should drive the whole equities markets and some of those higher growth companies, which yes, we do foresee that these tech stocks still have more room to run because whilst they saw the structural shift towards online last year, now you really start to monetize the existing customers that you have. And a lot of those people that perhaps didn't switch, those SMEs, perhaps they didn't have the capacity. Now they realize the value that you've still got that leg of growth to start come through. And there are other stocks like WiseTech, which is a volume game, and that's how the revenue model works. So you've got this structural shift. Now you're getting volumes come back.
Just explain WiseTech.
Certainly. So what WiseTech does, it's logistics freight forwarding software. So every time you move a parcel from, your DHL, you send it to them, they've got to move it from the warehouse to the port, to the customs on the other side, and whether it's ship or air. Each one of those is a module in their software, and the company takes a clip of the ticket of each one of those transactions in there. So again, you've got leverage to volumes, even though you're getting more customers in that time moving from they were doing it more on Excel or on a local piece of software. More of them now have shifted to the cloud. Plus, then now volumes are picking up. So that's where we go back to your question. Is there more to go? Yeah, we think there is.
Okay, Altium is another one you cover.
Yeah, look, Altium, it's a good company. The challenge that we have is near-term earnings risk. Now, they're not your pure play SaaS tech stock, and that's something very important in all these tech stocks having a run. They're not all equal. So one way to think about Altium is what they do is printed circuit boards. So that's like a small chip that's inside all of your electronic devices. They don't print the chips themselves. They create the software for the people that create those. So there's a challenge with them is a lot of their customers, they pay for the license once a year, 3 times a year, but the bulk of them buy the license and then they don't have to necessarily renew it. So with that in mind, when times got tough, they saw a lot of pullback in their customers, and now the recovery process we just think is probably going to be a bit slower than what the company has foreseen, that there's risk to earnings in this coming result. And then also when we think about your addressable market, they've got a lot smaller addressable market of $1.2 billion, whereas you look at Xero, for example, they've got $76 billion addressable market. WiseTech's got about 15 US. So that's where you just think, hey, should I be paying for the same price for this? Probably not.
Okay. So when we think of these tech stocks, the ASX introduced, I think it was early last year, the All Tech Index. Why are we hearing so much more about them? Or is that All Tech Index making a difference for the S&P 200?
Well, tech stocks have got a lot more importance in the sector as a whole in recent years. You think there's now 8 tech stocks in the ASX 100 versus 2 just 5 years ago. They're growing fast too, is the other point. So over the last 12 months, you look at the tech sector that you mentioned, it's up 78%, whereas the ASX 200, that's up 28%. So why is it playing more of an importance? It's a factor of these companies are fast growing. And the pandemic again highlighted that this is accelerating the structural shifts. These are real businesses with real products that companies and individuals use, that as a result, they're becoming a more meaningful part of the sector and a part of the investment portfolio decision.
And do you think Australia can have a vibrant tech sector? NASDAQ obviously is the leading one, but there are countries like Israel and that have incredible tech sectors. Is Australia big enough and broad enough and deep enough probably to have a vibrant tech sector?
Yeah, it's funny that you say that. We have had some fantastic businesses come out of Australia. You think about those that are already listed. Xero came out of New Zealand, but it's our close peer. And then you've got WiseTech, again, a name. Canva's a private stock that probably won't list in Australia, but at the same time, it's an Australian business. And what's interesting about the Australian versus going in the US, there's a bit of scarcity value because we do have these high growth names and they're limited at this point. But we do think that they're growing. There's real businesses, there's evidence of large global competitors that, yes, definitely, I think we're a formidable player and we'll continue to see tech playing more of a meaningful role in our overall index in the future.
We'll be back with more in a moment. I'm talking to Jarden's Vice President, Equity Research, Elise Kennedy. You've touched on the diversity of tech stocks. You also have the buy now, pay later groups, which I always think of as tech stocks. You have gaming groups like PointsBet, which I think of as tech stocks. Am I right in doing that, or should I be more focused on the pure technology players?
I think you're absolutely right. There's an element of tech that plays a role in all of these stocks, and sometimes you can look at a stock that effectively doesn't look as though it's tech, but if you see an element of high growth within there, and we saw that, for example, as you mentioned with some of those wagering stocks, you start to see the digitization of that, and that's a higher margin product. So yeah, I think it is important to look across technology, across all stocks, and even AI, if you think about that, in the role that that's going to play in healthcare in the future. It's not just, is this a tech stock? It's a matter of what role will artificial intelligence play in the future for healthcare?
You must have a great job, because not only do you have to look at financial metrics, you actually have to envisage the future.
It is a lot of fun, that's right. But exactly as you describe, it is being futuristic, thinking about what am I using, what is trending in the environment, what's happening in the startup land. And that is something that we have started as part of our work here in Jarden, is about pushing in there about early stage and what role do those businesses play, because a lot of those smaller businesses that we don't know of today on the market are likely our future disruptors. So it's important to really know what's happening in that private VC space, because they might change the landscape as it is today.
Are there any particular sectors or areas that you think are ripe for technology startups? ESG, for example, or energy or things like that.
Yeah, there's a lot that are happening in that space at the moment around the ESG focus. I saw a business recently where you go shopping and you get your rewards paid, your loyalty points, into your superannuation. So trying to bridge that gap, particularly for females in superannuation. So yes, there's definitely ways that are, that's smart. That's a unique way to solve a real world problem using your tech platform there. So definitely, I think those are one area. Healthcare, as I mentioned, I think there's a lot to be done in there and automating it. Same even in the retail space. They really haven't fully captured the potential like we see overseas when it comes to the distribution and the last mile and the technology that they can get in there to get it right to your home. You talk about drones one day. It sounds far-fetched, but supposedly there's testing going on. One day that might just be how we get our deliveries, and one day not too far in the distant future.
Elise, thanks for talking to Fear and Greed.
Thank you, Sean.
That was Elise Kennedy, Vice President, Equity Research at Jarden.